Hello, everyone. Welcome to the final bar. Today, we're going to talk about the market with its resilient uptrend. We ended last week in a position of strength, but really unable to follow through to the upside, teasing 3,400, but not able to eclipse it. If you were waiting for that moment, the moment arrived today with the S&P closing up above 3,430, it looks like, with a nice rally going into the close, led by the late cyclicals, the MEI trade, financials. We're going to dig into all of that and more. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the activity of the day through the lenses of technical analysis and behavioral finance, trying to make sense of what we're seeing using the different levers we can pull as technical analysts, as chart users. We can hit the market from three different perspectives. I would say as an equity investor, the top-down sort of macro, the sector rotation, sort of mid-level, and then the bottom-up stock picking. And every Monday, we try to hit the market from each of those levels, try to focus on some key themes that have emerged over the last week. And as I mentioned earlier, this was a resilient move from stocks, really rallying into the close. And it was led by some of the laggards that we've seen recently, particularly energy, industrials, materials, financials actually coming off pretty well. So some of those groups, again, not in long-term uptrends, are sort of coming from a position of weakness, but you also have the support of things like technology, consumer discretionary, communication services, sectors we have been familiar with and comfortable with, certainly continuing further to the upside as well. So we're left with this, this disconnection of sorts between a market that continues to go high and so much speculation, and I think with good reason, that the market's overextended. It's finally achieved this long-term resistance. Does it really have the does it really have the momentum to push much further than where we're at? Days like today make it feel like there's no limit to the upside that this market can achieve. Now, we're gonna have a fun time today on the show. We've got great guests coming up with you the rest of this week. Coming up tomorrow on Tuesday, we have Roman Bogomazov. On Wednesday, we have Doug Bush coming from Chart Smarter in the New York area. Thursday and Friday, we're actually going to be taking off from the show. We're going to take a holiday. The host of the final bar will be down in Oregon with my family, regrouping, reconnecting with things, and then we'll be back strong on this coming Monday. Also wanted to point it out, coming up on September 22nd, we're working on a fantastic event for you. It's going to be a 2-hour event called Introducing StockCharts ACP. We're going to have Chip Anderson, the founder of StockCharts, Grayson Rose, and I from the management team. We're all going to be sharing the latest iteration of StockCharts, the advanced charting platform, or ACP. It's a dynamic, fluid charting environment, really, really well designed. Our programmers, our developers have been working hard to upgrade it using, and we've been working together to do some really fun things with it. Also, a lot of fantastic plugins from guys like Dave Landry, Arthur Hill, Larry Williams. We're just finalizing his plugin right now, Miss Schneider, and Keith Schneider from Market Gauge, and many, many more. So it's going to be a fantastic event, September 22nd. Mark it on your calendar if you could. Well, let's continue on with our recap of today's market activity. As I hinted earlier, this was certainly a follow-through day to the upside, and the reason why I'm not gushing over with optimism with the extended upside that I see for the market from here, it's things like the volume has been relatively anemic, right? And if you look at, see how quickly I can bring up a chart of volume. Here we go. So this is the S&P with the volume, and again, if you look, just the trend in the volume for the last 2 months overall has been incrementally lower. And this last week or two, for sure, as the S&P has approached 3,400 and now pushed above it, eclipsed it in a meaningful way, the volume just overall has been less and less. Now, on balance volume, because it's geared towards daily up and down closes and it accumulates that volume, it actually is confirming it's going to new swing highs, which is good. There have been plenty of up days here that have certainly helped that to happen. But overall, if you just look at the trend in the volume, it feels like it's been lightening up rather than strengthening. The breadth is what concerns me a little more, and I don't mean to pound the table as a raging bear here, but it's clear that stocks are going higher. It's clear that the trend has been positive. So why am I not excited? It's this chart right here. We talked about this a little bit on Friday, really last week, and so as the S&P has been going to new highs, this is the cumulative advanced decline lines for common stocks in the New York Stock Exchange, for large cap, mid cap, small caps. Notice how they're all going lower for the last week and a half. So, the market going higher while breadth is all going lower. That's pretty classic bull market top behavior. And so that, those are some of the reasons: lighter volume, weaker breadth. These are some things that concern me. Having said that, it's undeniable that the market keeps closing higher. And again, as looking at the daily chart of the S&P, I don't think now is the moment where you recognize that the S&P is in an uptrend. If you were incredibly prescient, I would say the earliest you could, from a technical perspective, identify not just that the market may bottom, not the falling knife, but the fact that the market was in an uptrend, probably the higher low here, first week in April, you could acknowledge, yes, we have now established a higher low. We're breaking above Fibonacci levels, like right about there. I think the early adopters are sort of understanding that that's what's happening. Somewhere between here and there, something happened between individual names or sectors or this chart of the S&P that demonstrated to you that the market was in an uptrend. I know for me, I certainly thought it, thinking that we were just ready for another leg down because of all the headwinds that I recognized. But the market has continued higher. There's no denying it. The bearish divergence that we've talked about, even through Friday's close, has appeared to alleviate it a little bit. We're now getting a higher peak in the RSI, so it's no longer a lower peak. We're now in another upswing. So all these chances that the S&P has had to turn lower, it has avoided those. And I think this is why trend following is so important. The essence of trend following is not to guess when the trend is going to end. It's to recognize the direction of the market and stick with the momentum as long as the momentum persists. As we've talked about, the momentum has been positive. Even though I've seen signs of weakening internally, I've not seen signs in weakening trend, because the trend overall has been up. And until that changes, I think you have to be leaning into stocks and recognizing that there are higher highs potentially to be had. If and when the momentum shifts lower, if and when you see a downturn, a failure that me and many others are certainly expecting as we test previous highs, that could be that's what I would be looking for. Just with the weekly chart of the S&P, and I'm going to bring this up, and we're just going to I think what I'm going to do is this: we're going to take a weekly chart of the S&P, take the daily chart, and just quickly make it into a weekly chart. Here we go, and let's look at what the pattern actually appears. So, I think what could actually be going on here, just to think about a longer term trajectory, is, what's now happening on the daily chart. The bearish divergences that we've seen have all sort of gone away, right, and over time. And every time it looks like a lower peak in the RSI, the S&P continues higher. What's interesting is on the weekly chart, you're still getting a bearish divergence that I'm not going to call a bearish divergence yet, only because I always tell you, as you're in an uptrend, you can't really say that this is a lower peak yet, because we haven't actually turned over. But this is where I'd be actually looking to identify if we get a lower peak in RSI and a higher peak in price. And this could be just a large bearish divergence on the weekly chart. But boy, that's a stretch to try to find something negative. Don't get me wrong, overall, the market has been in an uptrend. Just to wrap up our recap up here, I think it's worth noting the NASDAQ 100 was up, but lagged behind a little bit because technology was not the strongest sector today. Bond markets ended up being about flat. They were up in the morning and actually came down, so yields a little bit higher. And gold and silver certainly saw some money come off the table there in both cases. Both, again, positive in the day, but as the day went on, you saw rotation away from precious metals, away from bonds, into stocks that finished in a position of strength. That's our market recap for today. And again, I sort of stuck big picture on this one, just because it's the way we frame out this three-pronged approach to market analysis. We start with the big picture. We've done that. Let's now rotate to our second segment, sector setups, and focus particularly on sector rotation. What we want to do here is start with the RRG chart. This is the relative rotation graph, and then we'll look at some of the individual sectors, look at them as a group, and then break down some of the individual sectors. And again, I think what I'm seeing when I'm looking at sectors are, for the most part, charts in pretty good places. And when we get to the chart of the XLY and we get to the chart of the XLP, that's consumer discretionary and consumer staples, you're going to see that they're both in pretty decent uptrends, and even staples, which is lagged behind, it's just going higher, right, in terms of price. Technology, which is in the weakening quadrant, granted, and has come off, is now heading back northeast. So it's sort of the direction of improvement. And again, it's still furthest to the right, which means it's the strongest relative performer using this methodology. The vertical just sort of gives you the rate of change. And in general, northeast is what I'd call the direction of improvement or something like that. Lower left or southwest, I call the direction of destruction or deterioration, something like that. So we'll note that the XLK technology is heading in a positive direction, aiming back toward the leading quadrant. Compare that to something like materials, which overall has been doing okay, but is heading due south here. So it's telling you it's still outperforming, but the momentum, the strength in a lot of those gold names, chemicals, other parts of the material space, steel names, all kind of the momentum's alleviated a little bit. Healthcare is down here, and when we get to our shifting stock segment, we're going to focus a little bit on the biotechs because they've really rotated lower, and it's a theme I want to make sure that that you're thinking of if you've not paid enough attention to it yet. And you can see that out of all the sectors, this is certainly one of the weaker movements, heading further to the left and in the lagging quadrant. Consumer staples is an interesting one. Certainly has been underperforming, especially if you look at it relative to consumer discretionary. We're going to get to that chart in a little bit, but overall you can see it's heading in a positive direction, sort of improving. The leaders today, we're all sort of over here for the most part, right? You have financials, industrials, energy, all some of the four, and materials were sort of the four leading sectors today. These are all things that have been sort of coming off a little bit using the relative rotation graph. Energy especially. I mean, if you look from a technical perspective, I still think it's very hard to justify the trend in most energy stocks just because the relative strength has been abysmal and the price trends haven't been that meaningful compared to some of the high-flying, stronger, longer-term trends that you see in tech and consumer and other places. So energy back in the lagging quadrant using this this relative rotation graph. And as you can see, if we just put it in motion here, I think, if you look at technology over here on the right side, you can see how over the last couple weeks it sort of rotated in the weakening quadrant and now just sort of turned and heading back positive. And that, as I've used the relative rotation graph for a number of years, that's one of the patterns that we'd always look for, is something that had been very strong and it sort of just does a loop over here. Instead of making a big rotation around the benchmark and outperforming and underperforming and outperforming and underperforming, if it does a little rotation over here, what that means is overall, because it's furthest to the right, it's been performing pretty well on a relative basis consistently. And it's just this little cyclical up and down turn within that longer term uptrend. That tends to be a really good long-term chart. And that's why consumer discretionary and technology are sort of parked on that right side. They've just been strong long-term relative trends. And it's just been these, quick cycles of strength and weakness within that longer-term uptrend, which is telling you the staying power of those performance trends. Let's now look at the candle glance page. This is looking at all 11 S&P sectors and the S&P in the bottom right. Look for some themes here, and then we'll look at some individual charts. What jumps out at me as I was looking at the sectors over the last 48 hours or so is just, number one, just the long-term strength in some of these sectors. If we look at the XOY, communication services, technology, and to be honest with you, even consumer staples, even though it's been relatively a little weaker than the others, you can see how just these trends they're in solid uptrends. So in general, owning things that are in uptrends, making higher highs and higher lows above two upward sloping moving averages, in general, I think you'll feel pretty good about owning those types of charts. That's why those, especially those first three, have tended to perform very, very well on a relative basis. If you compare that to what you see with energy below two downward sloping moving averages, and while not necessarily making lower lows, it's actually been in a short-term upswing since the June market, since early July. Overall, it's in a downtrend below two downward sloping moving averages. It's in a downtrend, right? A longer-term downtrend. Things that are interesting to me: materials making a stepwise higher high, higher low. Industrials sort of emerging and breaking above its June high and holding up there are two interesting emergent sort of charts. Let's focus on a bit of everything here. I want to rotate next to financials. The financials were all up pretty big today. We're going to focus a little bit on some of the charts that make up this sector here in our shifting stocks segment. But just want to point out, obviously up pretty good today, up over 2%, outperforming the market, one of the top sectors. The story with financials, it's really been a masterclass in Fibonacci retracement. So, if you take the February high and the March low, you use that as your framework, you can see we peaked out in early June just above that 61.8% level. So keying in on that level, recognizing that we were there right at the 200-day moving average. We pulled back right from there down to the 38.2% level. That was a good interim support. From there, we bounced back up. We hit once again the 61.8% retracement and the 200-day moving average. We now pulled back and we hit about 50%, about midway between the February peak and the March low. And now today, we sort of rallied a little bit to the upside. So if we continue in a position of strength this week, we've got clear upside resistance with the Fibonacci retracement, with previous highs, with the 200-day moving average, and again, I would expect, I still see financials as a relatively weaker sector compared to many others until we would break above some of this resistance around maybe 26 or so to get above some of these previous peaks and get above the 200-day moving average. But overall, a nice bounce off of a swing low here. So, and if you look, we've had this pattern of higher lows, which is similar to some of the other sectors, and that brings me to industrials. Industrials, materials have both just sort of been emerging as stronger parts of the market. You can see the relative strength has not been, climactically good for things like industrials. It's not been overwhelmingly positive. It's not been a big outperformer since the May pullback. It's actually not been bad. It's outperformed a little bit over that period. But the price is what's most important to me. And it broke above 76. It now retested that and now rotating back higher. So this sort of in pullback mode last week. And then going into today, rotated back on the positive side. I think materials is the last one I just wanted to highlight to point out. This has actually made new swing highs. This is a trend line we focused on back in June and July. You can see we've broken above it. And now once again, threatening new closing highs for the cycle here. So really an impressive upswing from materials. The relative strength, okay, kind of holding in there since the March lows, but overall in a pretty decent place. The big relative winners have been technology, communication services, other sectors that we've highlighted already. We want to take a quick commercial break. We're going to be back with our next segment, Shifting Stocks. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Appreciating you joining us for the show every weekday. As a reminder, we love to hear from you. Love to answer one of your questions during our mailbag segment. We'll do another one Tuesday of this week, tomorrow. Two ways to get a question to us. One is via email at thefinalbar@StockCharts.com, or on Twitter, just tag us in a comment at FinalBarSCTV. We would love to hear from you. We get so many great questions as you're navigating these markets, trying to process all the patterns, all the breakouts and breakdowns. So shoot us your questions, and we'd love to answer them on the air tomorrow. Our next segment is called Shifting Stocks. This is now, we've focused on the macro, thinking about the broad market themes. We've now focused on sectors and seen some of these sectors that are starting to emerge. And now we'll focus on individual stocks. Sort of three themes I wanted to tease out in today's show. First was to revisit the Mindful Six. This is a group of 6 stocks that we identified months ago, and I sort of proposed we track these and just see how they're doing. It was around the pullback from the June highs. Here's a chart of the S&P at the top. So as we rallied, we'd broken above the April and May peak. We then pulled back and tested it off of the June high, and the question was, are we going to remain in this sideways trend? Will we break above the June high, or will we break below that swing low after we pulled back in June? One of those three things would have to happen, and thought it would be helpful to look at some stocks in different groups and see where they were at relative to that framework and start to make some assumptions. And the main reason for doing that was recognizing that after we broke into new swing highs and pulled back to a similar resistance to support here just below 3,000, the question was, if these 6 stocks start to break down, I think we need to start to be worried about a return to previous lows. But if they hold them, seems like we're in decent shape. So let's go through each of these 6 again, see where they're at now. So Applied Materials was number 1, obviously within the technology space. You can see, to be honest with you, this has been in a pretty good, consistent uptrend of higher highs and higher lows since we started the clock here in mid to late June. So overall, I'd put that in the positive bucket, in the bullish bucket at this point. Chart number 2 is Morgan Stanley, which I'm surprised to say that a financial stock is in the definitely the positive mode, but it's certainly been that way. If you look, these 2 charts aren't too different from one another. Applied Materials and MS Morgan Stanley. Now the relative strength characteristics look a little different, but overall it's still been in an uptrend of higher highs and higher lows since we started that clock. And today's rally really sort of cements that pattern of higher highs, higher lows. So I'm going to put Morgan Stanley in the bullish camp as well. Number 3, Starbucks. While this actually held support beautifully and every opportunity here a couple times to break down, it was repelled from support, bounced back higher, which is what you'd expect around a key support level, but it actually has not eclipsed its June high just yet, so we'll call that neutral. Chart number 3 is Cisco, and this is actually an interesting one. Cisco, along with Applied Materials, had looked fairly constructive, was threatening to break above its June high, and I was ready to start putting it back into the bullish camp, but it actually gapped lower. This was on earnings a couple weeks ago, so it sort of disappointed on an earnings release. You can see it's now gapped below its June low, and so I'm going to put that actually in the bearish camp at this point. Nike's probably the most impressive chart out of all of them, and if you look, the early 2020 high to the June peak now becomes this beautiful cup and handle pattern. We broke above that. It's a beautiful long-term base breaking to the upside. We'll definitely put that in the bullish camp. Finally, we have Disney, which was the first to break down and actually broke below support, came back in the neutral range, and now, as you see, has broken higher, retested it, and now starting to move higher from there. So the count, by my quick visual read of where they're at relative to that trend, 4 bullish, 1 neutral, 1 bearish. So I'd have to say the Mindful 6 as a group certainly supporting the uptrend that we've seen in stocks. And what's interesting is that that's not just a particular type of stock. Those are, obviously mega cap. These are obviously some large cap names that we're looking at, but they represent a number of different sectors, a number of different business models. So impressive that all 6 of them, or again, the read from the combination of the Mindful 6 overall fairly positive. Morgan Stanley is one of those 6 stocks, and so I just wanted to start with MS and dig into some of the themes within financials. Our second main theme. Financials were up pretty big today relative to the market, so Morgan Stanley up 2.5%. Morgan Stanley, as we just mentioned, one of the Mindful 6, and I think what's most impressive about this chart for me is when we look at RSI, I use it as a momentum gauge and looking for when it's overbought or oversold, and I think that tells you a lot about where we're at relative to the shorter term cycle, right? Where are we at within that cycle relative to the longer term trend? And are we overheated, just too aggressive on the upside or the downside? But if you look at the range of the RSI, it went above 50 here in mid-May and has not gone below that since. It's actually been above 50 for the most part, except for a little blip there in July. So overall, it's been certainly in a bullish range, meaning the RSI has not gotten below 50, which means overall the trend is fairly positive. Up days stronger than down days is how I would generally characterize that sort of pattern. It's pretty constructive, and at this point, not overbought. It's sort of in a decent point, just above 60, and it's pulled back off of another higher low, or pulling back higher. So overall, the trend is actually pretty positive. What's interesting, if you look across the board, the theme with financials, they all rallied pretty good. This is Capital One up almost 6% today off of the lows. So making higher lows and a lot of times making higher highs. The problem is the relative strength is relatively weak because a lot of these are still below moving averages, still below their June highs, while things like, Apple, obviously up here, right, well above their February high, right? They've emerged much more quickly than some of these financials. So, how do you think of them here? I would be concerned, and I'm not concerned, but I would be less excited to own some of these names as a longer-term investor until you start breaking above the June high. You saw at the Mindful 6, that was one of the sort of key things I looked at, right? We hit a peak. Are we able to eclipse it? Are we able to, buyers able to, push demand so it's able to eclipse that June high. And most of these stocks have been unable to do so. So coming off the lows, a nice rally, that's all fine. But overall, you're getting paid on a relative basis over the longer term, owning other sectors and other names. Here's Huntington Banks again, making a higher low, a higher high, coming off the low. So overall, the trend doesn't bother me. It's this line down here where the relative strength has essentially been flat to down a little bit, really, since the June peak. It's been underperforming, and it's still, even with a nice little pop, sort of similar to where it was after that sort of mid-April pullback. So financials are rallying very nicely today. I feel like that's one day. I'd much rather own stocks that are breaking out and seeing positive follow through and definitely breaking above their 200-day moving average. You've not seen that, and I would be keying in on those June highs with a lot of those charts we just looked at. The final bucket I want to look at is just biotechs, and if you've not paid attention to this group and you're still looking at names like Regeneron and others, it's getting concerning, and I think you want to be thinking about downside risk and potential to unwind, and just thinking about the downside potential and potential for capital loss here. This is the IBB, and we're looking at a 2-year chart just to show how there's been this rotation from a nice uptrend out of the March lows, really bottomed up before the March low, the peak in mid-July, and then see how the prices rolled over, and the relative strength has really gotten crushed. These had outperformed by 10%. Looking back over the last, since mid last year, early fall maybe, and since then has given up all those gains and much more, breaking down through swing lows. So if you think of the chart of Morgan Stanley, there's a nice little stepwise motion to the upside. Biotechs are kind of the opposite, making a stepwise motion to the downside. Largest names in the IBB would be Amgen, which is just broken below its 50-day moving average, making a lower high. Vertex Pharmaceuticals, VRTX, not quite a new lower low here, but 260 is a really key level that if it would break through that would be concerning. You have Gilead, which has come down below its 200-day moving average, certainly in a position of weakness, oversold actually, which is kind of an interesting thing to watch. Regeneron may be the most uncomfortable because it's not just gone straight down, it's just been this change in character is how I would describe it, from an accumulation phase to a distribution phase. We now have a lower high, a lower low, and I'm keying in on this low that we set over the last couple weeks, and a break below around 585, which we're really close to, would certainly validate a bit more further downside. New 6-month relative low this week, and the RSI just testing 40. So I think we're right at that point where a chart like Regeneron could start to look really ugly very quickly relative to some of these other stocks that have held up much better on a relative basis. That's our shifting stock segment. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Let's get started. Chart number 1 is looking at consumer discretionary versus consumer staples. We talked about the consumer discretionary chart looking good, making new highs on a relative basis on the RRG chart, far to the right and looking very good. It has continued to perform well versus staples. There's that period in July where it felt like staples are starting to improve. On a relative basis, that has gone away. On a cap-weighted basis, driven by the strength in Amazon and Home Depot and others, the relative, the ratio has gone to a new 12-month high. On an equal-weighted basis, you're also seeing it strengthen. I'll be looking to see if it gets above that high in June, which tells you it's not just the mega caps, not just Amazon, it's a lot of other names within the sector. Chart number 2 is looking at biotechs. We just spent a little bit of time on this. This is the IBB breaking down through its 50-day, making a new swing low yet again today. This is the IBB relative to healthcare. This is the IBB relative to the S&P 500. So it's not just that the sector's been underperforming and that the biotech's been underperforming the S&P. Biotech has been underperforming the rest of healthcare. So other groups like supplies and medical equipment and pharmaceuticals, I'm not sure about that one exactly, but these have all done better, I would assume, than biotech. So it's a bit of a concern. Financials, as I mentioned, that's our 3rd chart, and we looked at some of the individual stocks. Morgan Stanley is probably one of the best examples of a nice, consistent uptrend, but the average stock has really not gone above its 200-day moving average, similar to the XLF, and I'd love to see a break above that swing high. It's around 25.75. That's the Fibonacci retracement. That would be the 200-day moving average. That would be a new swing high. So I'm all for a bounce off of the lows, but I'd love to see it eclipse a meaningful level like that to feel good about longer-term appreciation from here. Folks, that's our show today. Thank you so much for joining us on the final bar every weekday after the close. As a reminder, we have some great guests coming up and also a lot of great guests on our YouTube channel from last week. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.